Good morning, everybody. It's a pleasure to be here from America. Do you all get the John Oliver show here? Is that a name that anybody would recognize? A couple? I'm not particularly a big fan of his. I think he skews a little bit leftwards. But he had a very funny line when he said, "What is Bitcoin?" He said, well, it combines everything you don't know about money with everything you don't know about computers. And I thought, that's brilliant, because it's so true. So I have a background in software. I'm a computer guy myself, but I'm not going to try to explain the whys and wherefores in the computer aspect of Bitcoin. I think there are others that can do a more competent job of that. But I want to talk about money, because I think that's something that's not well understood, and I think that's something that needs to be well understood, because we live in a world where our monetary system is failing. I mean, that's the backdrop to all of this. If the monetary system was working just fine, there wouldn't be a lot of discussion of gold necessarily, and there probably wouldn't be a Bitcoin. But our monetary system is failing in a lot of different ways and in a lot of different countries around the world. So I put this animation up of Bitcoin versus gold, and this is what I don't want to do in my talk today. I don't want to tell you what to think. I don't want to tell you this is the conclusion to form about gold or Bitcoin or whatever. And actually, I probably should have put dollar there as well. How many of you think the dollar is money? Raise your hand. It's interesting. So it's about 20% of the room. Last year at around this time, I gave a talk at an Austrian economics conference at the University King Juan Carlos in Madrid. So it's a bunch of Austrian school professors and academics, and somehow they let me into the room. And the first presenter, I was the second one of the conference. The first one said only gold is money, nothing else. And then the rest of his presentation was pictures of old gold historical coins. And the academics in the room really skewered this guy. I mean, they really grilled him. And they said, what do you mean, does that mean we don't have money today? Look at all the trade and the commerce and globalization and everything else. How could there not be money in the system? And I'm just sitting here going, just biting my tongue. And so I stood up and I said, okay, I'll defend this proposition, even though my talk was slightly different. And what I said to everybody was, sometimes in certain eras, there's a question that's hanging in the air, screaming out to be asked and answered. And so, if you go back to the time of Copernicus, the question that was screaming out was, okay, if it's really true that all the planets orbit around the Earth, how do you explain the retrograde motion? Right, so they look through telescopes, and what they see is all the other planets go forward a bit, and then backwards, and then forward some more, and then backwards. And there's nothing that you can really explain that. And Copernicus was, I believe, I know somebody's going to probably beat me up historically, but I believe he was the first guy to say, no, you got it all wrong. You see, the sun's in the center. And when you put the sun in the center, everything becomes much simpler. Now you realize that this apparent retrograde motion is just simply an artifact of the fact that we are too going around the sun. And by observing other planets that are also going around the sun at different speeds, then their motion relative to us gives this apparent retrograde, but actually everything is nice ellipsis. And so the question that's, I think, screaming out today is the dollar money? Is Bitcoin money? Is gold money? Et cetera, et cetera, et cetera. So the question that I posed to that particular conference, and I said, look, you don't owe me an answer. I'm just some schmo from America here in Spain talking to y'all. But you owe yourself an answer, and you owe yourself an answer that is a rigorous answer. And that is, if you look back to the 19th century, the dollar was redeemable. That meant that you could take that paper $20 bill, in America at least, and you could push it across the counter to the teller at the bank, and you'd get back a gold coin in return. If the word for the paper is money, what is the word for the gold coin for which the paper redeems? And when I finished my talk, nobody gave me any hard time. I got 2 or 3 what I would call ordinary questions, and then sit down into the next speaker, because I think I I think I made them think, which is a good thing. So, you've all heard this little ditty, money is a matter of functions for, medium and measure, a standard store. Has anybody come across this in there? This is an old economics, like Econ 101 type adage, where this is sort of the conventional view, or I guess before what we would call the postmodern era, which we're in now. This was the conventional view of money, that money has to do these things, right? And something does that, that's money. So I wanted to sort of structure most of my talk around these four things, and then sort of compare dollar, gold, Bitcoin, and see how they stack up. And then I'm going to talk about how this isn't necessarily right, but it's sort of a good starting point. And so first, let's start with medium of exchange. Is there any question, is there any doubt that the dollar serves as a medium of exchange today? I don't think anybody would raise their hand for that. Dollar is actually a perfect medium of exchange. You can send it anywhere in the world, near instantaneously, at zero cost, or maybe you pay a $20 wire transfer fee. If you're willing to send it in 2 days, then the fee goes down, or it's free in a lot of cases. Bitcoin also works as a medium of exchange, although I would point out there's two issues with that, which is one, the speed of its transfer is not necessarily particularly good, and there is a cost because the network can only support so many transactions per second. So the people that sit at those nodes obviously want to find the right way to ration a scarce resource. Pricing is usually how you ration a scarce resource, unless the government comes in and gives favor to those that have political connections. The other thing with Bitcoin is that usually the merchants don't actually keep Bitcoin on their balance sheet. So let's say I'm an online vendor and I sell flat screen TVs. I buy flat screen TVs from the Samsung or LG distributor, and I sell them to consumers, and I make, if I'm lucky, a 5% markup. So if I get $1,000 for that flat screen TV, I can't hold $1,000 worth of Bitcoin, because I have to turn around and pay the distributor who has to pay Samsung or LG, whoever makes the TV. And so what happens in this transaction is there's actually a number of implicit third and fourth parties. There's a third-party currency broker that, so I price my TV at $1,000. That's what I need in order to stay in business. The third-party broker knows what the Bitcoin price is as it fluctuates, and for anybody who wants to pay in Bitcoin, quotes a Bitcoin price plus some markup. The Bitcoin guy says, okay, well that's, today's, whatever it is, 0.1 Bitcoins or something like that. So that person pays the Bitcoin, and then there's a fourth party who actually wants to buy the Bitcoin, who has the dollars. The third party currency broker brokers that transaction. So the guy with the Bitcoin gives up his Bitcoin, gets the TV. The guy with the dollars gives up his dollars, gets the Bitcoin. And the guy with the TV gives up the TV and gets the dollars. And so I want to just cast a little bit of doubt as to whether it's functioning as quite as a medium of exchange there. Obviously, there's some friction in that. And the broker has to charge a markup to cover that friction. But that aside, both Bitcoin and the dollar serve as a medium of exchange. Today, largely gold does not serve as a medium of exchange. There are some people that are trying to do sort of off-market gold transactions. Every time I talk about this, there's always somebody in the audience who knows of somebody whose brother has a friend who has an uncle who bought a piece of real estate and paid out gold coins for it. And I'm sure that must exist out there, but it's an anomaly. I mean, it's like saying that everybody has, 2 arms and 2 legs, and you can find somebody who doesn't, but the exception doesn't necessarily, prove the rule. And why is that? Why does gold not serve as a medium of exchange? Does anybody have any insight into that? It's bulky. There's a frictional cost to it. So I wrote an article for Forbes some years ago, creating a hypothetical scenario of some river delta culture in the ancient world that was just emerging out of subsistence. So in a subsistence world, everybody has to produce everything they need for their own lives. And of course, they're grindingly poor and life expectancy is very, very short. And at some point, they produce just enough surplus that allows the beginnings of specialization, and with specialization comes a big step up in productivity, and with that step up in productivity, quality of life and wealth and so forth. So suppose you have a fisherman and you have a guy who makes leather moccasins, just two particular actors in this little primitive economy. And the guy who makes the leather moccasins is hungry, so he goes to the guy who pulls the fish out of the river and says, I want to make a trade. I'll trade you a pair of leather moccasins for 5 fish. And the fish guy says, okay, great, yeah, I need to put something on my feet. That sounds like a great deal. Let me go do that. And so they do the trade, and the moccasin guy eats for 5 days. We won't deal with the issue of refrigeration and the fish might perish. Let's say it's dried fish. And then on the 6th day, the guy who makes the leather moccasins comes back because he's hungry again. And he goes back to the fishing guy and he says, okay, let's do the trade again. The fishing guy says, wait a minute. I still have basically new shoes. I don't need you today. Come back in 6 months when these are worn out. So they both have a very big problem, and of course the moccasin guy has a bigger problem than the fishing guy. And so economics has a term for this. This is called the coincidence of wants. That is, in order to do a trade with pure barter, not only do you have to produce something, but you have to find somebody who produces what you need and who happens to have the need for what it is you produce. And so the moccasin guy in this scenario could probably spend all day, if not several days, running around to everybody to find out who needs moccasins at that moment. And maybe it's the guy who produces decorative beads. And then he has to go find somebody else who wants decorative beads, and he's trading around to finally get to some food so that he can get his dinner. So barter doesn't really work very well, and it doesn't scale, even in a village of, let's say, a few hundred people, let alone a global economy. So the solution to this is indirect trade. What they discovered somewhere in the ancient world, and we don't know if this is 20,000 years ago or 10,000 years ago, but it's sometime very, very long time ago, what they discovered is that each particular good has a certain degree of acceptableness in trade. So if I trade, let's say I produce moccasins, and I trade the moccasins for salt. Now maybe salt isn't what I need, but what I find is that a lot of people are happy to take salt. Salt is used in food preservation, and everybody has that problem. So I trade from moccasins to salt, and then salt to food, and I find that's very much more efficient. And so salt becomes used, among other goods, salt becomes used as an indirect medium of exchange. But what markets tend to do, and we see it today, it happens so much faster on the internet, it's called winner take all. That is, if salt is better than moccasins, what's better than salt? Anybody know where this is going? Well, before gold even, silver. Silver was really the replacement for salt because it's something that the smaller, the wage earner, somebody an artisan can earn in a week. He can earn a little bit of silver, because gold is too valuable for that, and he wouldn't necessarily get his hands on any. So what we can do is we can stack rank all of the goods in the economy in degrees of what is now called marketability, from low marketability, which would be fresh perishable food and moccasins, and then somewhere up here is salt, and then maybe cattle. Does anybody know why cattle was used as money? It moves on its own power, right? So if I'm gonna do a very big transaction, I'm gonna buy whatever, 100,000 acres, and then I pay with cattle. Well, now the person who just sold the land obviously doesn't have the land to keep the cattle on, but he can drove the cattle somewhere else relatively cheaply because they move themselves. And so that ability to get from one local market to another local market really makes cattle very marketable because you can bring them to wherever the demand is. If there's a saturated market over here, maybe there's a market that's hungry over here. And so you can stack rank all the goods, and what you end up with, and this is the conclusion of my Forbes article, gold is the most marketable. Now, the reason why this is important is nobody's thinking about economic theory, certainly not 10,000 years ago. And as Carl Menger observed, even in the 19th century, the people that are in the market trading every day are not thinking about economic theory. What are they thinking about? Making money. That's what matters, making money. So the reason why all this stuff with marketability matters is the more marketable the good, the smaller your loss to trade in and out of it. So I've got moccasins. If I trade into dried fish, let's say, and then I trade my dried fish for whatever it is I really want, let's say fresh food, well, dried fish isn't that marketable, which means when I pay, I'm gonna have to pay a higher price, and when I sell it, I'm gonna sell it for a lower price. That's the offer price and the bid price, the bid-ask spread. That spread is the measure of my loss, because I pay here and I sell here. I want the more marketable good. So everybody has the most powerful incentive possible, which is the profit motive, to find the one good that's more marketable than all the others. And then as Menger pointed out, once people select gold, it becomes even more marketable than it had been before, because now it has marketability as money on top of all the marketability it had before it was money, and the reason why it was selected to be money in the first place, which is another way of stating what Mises calls the regression theorem. Anyways, I'm deviating aside here a little bit. So in order for something to be used as a medium of exchange, it has to be efficient. And what efficient means is not having a lot of cost in terms of bid-ask spread. If I want to buy it, get into it, and then sell it, what is the bid-ask spread? And you can look at all the commodities in the physical world, and even today in markets, you will see gold has a bid-ask spread that is 10 or 20 cents per ounce on a $1,500 per ounce price. So the bid-ask spread is 0.000 whatever, 1%, I don't know. Bitcoin, I believe, is higher. Everything in the financial universe is higher except for the US dollar, probably the euro, maybe the pound, and treasury bonds. Those are tighter, but they're not commodities. All right, so we talked about medium of exchange. The dollar is actually flawless as a medium of exchange. So I was at a Bitcoin conference in New York, this is probably 4 years ago now, and Blythe Masters, who had been at JP Morgan, I believe, was then involved in a blockchain startup. And she kind of challenged the audience a little bit, which was a lot of Bitcoin blockchain developers that were raising money to build their apps. And she said, I challenge you, what's your value proposition? If your value proposition is a cheaper, faster way to transfer than the US dollar, she said, the US dollar has some problems in that. So you could say, in a certain sense, it sucks, but it doesn't suck that much. And so if you're trying to optimize something that's already pretty optimal, you're not likely to be successful with that value proposition. You better think of something a little more creative than that. And I thought, wow, this person's fairly smart. Now, her company, I believe, went out of business as well, but that's a different story. All right, let's talk about measure. So I went and Googled just to find, I remember this old ditty, money is a matter of functions for, but I wanted to Google it and get the exact one, and there's a zillion articles on Google. If you Google this, the one I happened to find was written by a Bitcoin proponent, and interestingly enough, and I don't know when this was written, but it must have been some years ago, he said Bitcoin is a measure. And he said, for example, I can measure my laptop at 1.5 Bitcoins. What is Bitcoin today? It's over 8,000 US dollars, right? Is there such a thing as a laptop at $12,000? Maybe. The high-end gamers have these crazy things that can do 10 trillion polygons a second and has a 17-inch screen, and you call it a laptop even though it weighs 20 kilos or something. So this area of measure is where I think if you compare gold, Bitcoin, and the dollar, clearly the dollar fails. But if you take a look at what prices looked like a really long time ago, say 100 years ago, they almost become jokes. They almost become memes on Facebook and Twitter for what was the price of a liter of petrol 100 years ago. And it was like 5 cents or something like that, right? So in terms of measure of value, if you say, when I started, my career, I made $10,000. Well, we don't know if I'm, an unskilled laborer or if I'm just old. So we have this problem that the dollar falls over time, and then we try to adjust it. So I like to use an analogy. Suppose I'm a structural engineer and I'm designing a really tall building, 100 stories or some crazy thing like that. And suppose it were true that the meter shrank as I went up in elevation. So every floor, there was a slight shrinkage in the meter, and by the 100th floor, a meter was this long. And so then the engineering and engineering trade, and of course the physics, the science of physics, started to come up with height-adjusted meters. And so on the plans, it would say, this beam is supposed to be 17 meters, and then it'd say in parentheses, 50th floor height adjusted. And if this happens to be the 51st floor, everybody would have to know the equation for how much the 51st floor meter shrank relative to the 50th floor meter. So imagine if this was how you had to build buildings. Would there be any expectation that these buildings would actually stand straight and not fall over as soon as they let go of the scaffolding? I mean, it's a mess. But that's what we have in the dollar today, is this idea, well, that's inflation-adjusted dollars. So it's $2009, that's $1940. And it renders the whole thing into kind of a joke. But on a more serious basis, if you are talking about long-term investment, so we live in a civilization today where we're not subsistence. It's not just simply what can I pull out of the river with my own two hands today, this morning, determines what I can eat this afternoon. It's an entire life of planning. We have very low what's called time preference. So we spend all these years in school, and then we spend more years in graduate school and so forth, and then our first 10 years of job is almost more training and more education till we finally get to the point where we're in a comfortable place and doing what we want to do. How can one make a long-term investment if one is measuring it in a defective unit of measure? So we say, okay, well, I invested $10,000 back at a time when, let's say, a senior engineer made $10,000, and today I sell it for $200,000 at a time when senior engineers might make $200,000 in Australia anyway, or probably even more than that if you go out to the Western Australia and the mining districts. Senior engineer probably make a hell of a lot more than that. So $10,000 to $200,000, $190,000 profit, but the dollar shrank. We all know it shrank, we just don't know exactly how much, and measuring it turns out to be basically impossible. And so, of course, the tax man says you have $190,000 profit, pay your tax on that. So you're losing something to the tax man, but did you really make or lose money? This is a non-trivial question, both to answer and the importance is paramount to civilization. If it's not possible to invest for the long term, our civilization is going to collapse because our whole civilization is based on long-term investment. If you screw that up, you screw up everything. At the end of the day, every enterprise has to answer the question, am I creating or destroying value? So if I'm nothing more than a concession at the stadium where they play football, so all I do is I pay rent for the day, I buy some hamburger meat and some buns and some mustard and some ketchup and some frozen potatoes, and I use their equipment, and I sell all my stuff as finished product, and I paid $1,000 for my raw materials, and I sell it for $2,000, and I had $500 worth of labor, we can say I made $500. Black and white, there's no question. The dollar works perfectly fine for that. But if I had to borrow $1 million to build the building and buy all the equipment, and then amortize that over 20 years, then even though the dollar may suggest that I'm making a profit, that profit can be illusory because it's actually the collapse of the dollar, not the gain in my investment. So that question is really, really, really important. Now, let's take a look at Bitcoin for a moment. And this curious example of my laptop is worth 1.5 Bitcoins. Now, to give you the punchline on that, Bitcoin was $300 at the time that article was written. I scrolled down to see what he was talking about with that. So he had a $500 laptop, okay, fine. But now let's think about long-term investments denominated in Bitcoin. So if you go back to 2009, Bitcoin was $1, wasn't it? At one point then? So if I invested 1 million Bitcoin in some sort of business, okay, that's a reasonable investment, and $1 million, 1 million Bitcoin, great. And then what happens over the succeeding years is the value of my investment collapses to, in 2017, my investment would have been worth a mere 50 Bitcoin, because Bitcoin was $20,000, so $20,000 per Bitcoin is 50 Bitcoins is $1 million. So in terms of a measure, Bitcoin fails. And even though Bitcoin people will tell you, well, it's a great measure, and it can be used as a measure, and you certainly can do the math. I mean, the spreadsheet won't refuse the division operator. It's not telling you anything useful. And of course, the business didn't collapse from 1 million to 50. It's that Bitcoin went up so much. Now, that's great if you bought Bitcoin and it went up, bully for you. But in terms of as a measure of economic value, that's not really useful. So the dollar, of course, fails as this. Bitcoin fails as this. Now let's talk about gold for a moment. Obviously, the price of gold's all over the place. The question is that just the inverse of the price of the dollar with which we measure gold, or is that actually gold going up and down? So to go back to the meter stick analogy for a moment, the only way to measure a meter is a meter, right? Meter is the measure of length. So even in my analogy, when I say if the meter is this long at the ground floor, and by the 100th floor it's this long, even that's a visual reference to length, essentially. So the way to measure length is a meter, and the way to measure a meter itself, there's nothing else with which to measure it. You wouldn't say a meter is 1/1000th of a building long. You can't, so buildings are measured in meters, but meters can't be measured in buildings. That's the problem we try to do with the dollar. We say, well, purchasing power of the dollar has gone down. Prices are measured in dollars, but we try to measure dollars in prices. It becomes circular. So what I would suggest is the measure of a meter is a meter itself, and the property that we're looking for is that the next meter has the same length as the previous. That is, all meters have the same length. So there's a meter in America, there's a meter in Australia, there's a meter in the top of the Swiss Alps, there's a meter in the bottom of a trench in the Pacific Ocean. As long as all those meters are the same meter, then we're in business, at least from an engineering perspective. The same thing should be true in money. So what's the measure of a unit of economic value? And the only way to measure that is by using the same measure of economic value. So to frame it in the same terms, what I would say is the property we're looking for is that the value of the next ounce of gold is the same as the value of the previous ounce of gold. That's not true for dollars. We clearly see it. As the quantity of dollars is rising, there is some falling of value, although it's not nearly as tight as most people would think. Which currency, by the way, has the greatest quantity by far? US dollar. The US dollar has a greater quantity by far. In fact, it's probably greater than all the other currencies' quantity combined. It's that much of it. And yet, the US dollar, if it isn't the highest priced currency in the world, is one of them, and obviously the most important by far. So it isn't quantity per se that governs us. So what we should see is that the value of the next unit of gold is the same as the previous unit of gold is the same as the previous, and the previous, and the previous, all the way back. Now, what's our measure of that? How do we know that? I mean, is that just a crazy supposition that this crazy American standing on this stage says? Is that true? How could we measure that? Well, there's a fact that I would think most people in this room are probably aware of, and that is virtually every ounce of gold mined in at least 5,000 years of human history is still in human hands. And that said, the next 2,000 tons of production, or whatever is going to come out of the ground this year, finds a ready market. Is there any other commodity that comes remotely close to this in terms of this particular property. That no matter how much we accumulate, the market always is willing to absorb more, and the price of the thing has nothing to do with how much has already been accumulated. It's not like, well, the more we accumulate, the accumulation goes up, price goes down. It's not like that at all. Price moves up and down for a variety of reasons, and we continue to accumulate. And so what I'm talking about is marginal utility, the value of the next unit in relation to the previous unit, and that for gold is a constant, and that's what gives gold makes gold a measure of economic value. Standard, I think, is probably a bit less important to dwell on in this context, because I think all three of these, certainly, there's different dimensions of standard we can talk about in place. So the Australian dollar would not be marketable outside of Australia. The US dollar, I think, largely would, and gold certainly is, and Bitcoin certainly is. With the internet today, you can go anywhere in the world. You also have time. Gold, as somebody pointed out in James in the previous presentation, 6,000 years ago, gold was marketable. We have every reason to think 6,000 years from today, gold will still be a standard. The dollar, almost certainly not. Bitcoin's the giant question mark. I don't want to dwell on that too much. I think standard really derives from measure, because what standard really means is if I can say, I have a company and the company is worth $1 million, everybody knows what that means. It doesn't need to be further explained, although as we talk about in time, if I said, oh, by the way, I meant 1968, you realize that was a hell of a lot bigger company. A $1 million company today is nothing. Finally, let's talk about store of value. Clearly, the dollar is if it's a storage container, it's one with a slow leak. And the slow leak is actually not a bug, it's a feature. If you go to the Federal Reserve's website, they say they have a mandate for price stability, which they define as relentless 2% inflation forever. So I think, first of all, we need to be aware that George Orwell would be looking down from heaven or maybe up from hell, respectively, saying, gotcha. But the problem is, of course, they overshoot and they undershoot. And so when they're not getting as much leakage as they want, they keep turning the valve opener and opener and opener. And then, of course, there's a risk that, it's like stick-slip dynamics. You have this conical pile of sand, and you keep adding one more grain and one more grain because you want to get a little bit of slippage. You don't get a little bit of slippage. It sticks, and it sticks, and it sticks until abruptly, the whole thing goes. And so they're playing with something very dangerous with what they're doing. And it's clear they don't know what they're doing any more than anybody else does. Let's talk about Bitcoin for a moment, because this is interesting. And so I'm not going to give away what I said, but on Monetary Metals' website, I think I wrote a dozen articles about Bitcoin. They were all written, well, one or two were written more recently, but most of them were written during the time when Bitcoin was in the skyrocket phase. It was like May 2017 to December 2017. I think the last one I'd written in that series was right before Bitcoin had peaked and come over. And then in a subsequent article, I said I didn't know that, and neither did anybody else, that was going to be it. But I think something is fair to say, and that is, in the skyrocket phase, even in the skyrocket phase, that's not a store of value. A skyrocket is not a storage tank. Now, if you own it, you might be really happy to see it going up, and that's great, but that's not storage. That's something else. And of course, at that time, the Bitcoin market wouldn't acknowledge the universal truth that anything that goes up like that does come down. Nobody can predict when, and shorting it is extremely dangerous. I certainly wouldn't recommend anybody shorting a market like that, or like silver in 2010 to 2011. But it does come down. And then when it does, it puts the lie to the storage claim. So I talked about most marketable commodity earlier, and that's necessary for medium of exchange. But I want to talk about extinguisher of debt, probably for most of the rest of my talk. because I think this is, there's a number of unappreciated or underappreciated issues here that really drive our civilization. I mean, I think they're that important, even though they may be counterintuitive. And so let's start out with a loan. And so loans have had a very mixed history in terms of what thinkers thought about loans. And so Aristotle, I think he was one of the good guys, generally thought that a loan that paid interest was unnatural and said something like gold does not beget gold. You know, wheat begets wheat and cattle beget cattle, but gold does not beget gold. So he thought there was something wrong or something screwy about it. And of course, you know, religious authorities were against lending. It was called usury. I think today there's some debate as to what usury is. It's the charging of excessive interest. But there was a long period of time where usury was the charging of interest, period. And so you can drive lending underground. People still did it because it was profitable. But you know, there was a risk of death at one point in medieval Europe for lending. But I think at the core of it, a loan is a win-win deal. First of all, any deal that occurs in a free market is win-win. Otherwise, the two parties wouldn't be doing it, right? But what is a loan in its essence? A loan is somebody, usually a younger person, who has energy and some income, already has some income, and has a great business opportunity and needs some wealth or some capital. And then the guy on the other side is usually older, often retired, who has some wealth or capital and wants to get income on it. And so rather than burning his savings in retirement, this is what people did in times when there wasn't lending. All during your working career, you accumulate salt or silver, and then you get to the point you can't work anymore, senescence, it's called. You get to that point, and now you have to start selling little bits in order to buy groceries. And all that time that you're selling, you're living with a terrible fear, and that is, am I going to outlive my money? Am I going to be that poor old guy on the steps of the church begging because I'm not going to eat if somebody doesn't give me a little bit of something? Nobody wants to be in that position. So what lending does is it now makes it possible for that person not to actually consume his principal, but to live on the interest. And so I think I would call that the driving force of civilization, and it's certainly one of the dominant forces that got us out of the Dark Ages, some centuries ago. Because what does it do? First of all, it gives as I just said, the older person, it gives him income, so he's living on the interest and not the principal. So that allows him to live significantly better. And it gives this young person who has a great idea to do what? To either create a new product, and produce it, or to produce more of at lower cost an existing product. So not only is he getting rich, and some of the proceeds of this new business, this new production is coming back to the person who financed him in the form of interest. Not only is he getting rich, but all of society benefits because he now has a better new product that people hadn't had before that make their lives better. And so this lending at interest is a really, the economic driver for civilization ultimately. So just as an aside, one of my great complaints about our world is, of course, the central banks have driven the interest rates to 0 and beyond. Right? So they're actually negative in Switzerland and Germany, Japan, a number of other countries. We're seeing entire yield curves going negative, right? It's not just the short one. In Switzerland, it's all the way out. And in Germany, it's all the way out, at least to the 10-year bond is negative yield, which means you give them €1,000 and 10 years later you get back €990 or something, which is just madness. So what do people do? They turn to speculation. They turn to whatever their favorite asset is, which could be stocks, it could be antique Ferraris, it could be real estate, it could be gold, it could be Bitcoin, it could be whatever. I'm gonna be an equal opportunity hater here for a moment and say, what do they want to do? So they plow a bunch of cash into a particular asset. They want the price of that asset to go up, and then they sell it, and that's a surrogate for earning interest. The problem is, even though it produces a similar effect, I say similar because at some point there's a guy who gets caught holding the bag because everyone's buying it as it goes up. Somebody bought Bitcoin at $20,000. So for him, this was not a surrogate for interest. This is a surrogate for just throwing your cash into the fireplace and lighting a fire. But for everybody who's buying on the way up, this is wonderful fun. It seems to be a surrogate for lending at interest, except for the difference being lending at interest, your profit comes from your share of the increase in production. In the case of speculation, where does your profit come from? Anybody want to hazard a guess on that? It's somebody else. So if I frame it in these terms, and I use the term, do you all have the term in Australia to fork over? Is that an expression here? So in America, we say it all the time, I fork over $1,000. So let's say Bitcoin's $1,000. I fork over $1,000 to buy a Bitcoin, and I'm hoping it's going to go to 2,000. It goes to 2,000. I sell the Bitcoin. Somebody else is forking over $2,000 to me. So I take my $1,000 capital back. I certainly don't want to eat that. $1,000 of it is profit, and I can go consume that. And so I'm now consuming somebody else's life savings. And nobody wants to be the prodigal son, but yet we now have a central bank created situation where there's a perverse incentive to consume capital. And so lending is a win-win deal of an exchange of wealth and income. Speculation is a win-lose deal. It is a conversion of wealth into income. And I use the word conversion in English common law. Conversion has a sinister overtone. It's like an illicit taking of value. Not necessarily illegal, but there's something not quite right about it. And so I'm now consuming somebody else's capital, which comes to me as income. It's my right to consume it legally, but there's something wrong with the system that sets this on fire and unleashes this. And so getting back to lending, and I think this is so important, this is the win-win deal that drives civilization, is investment in something productive, not a bet in the casino and spin the wheel. So what does it take in order for something to work as a medium of lending? Well, first of all, the value has to be stable enough. And what I mean by enough, I mean, people can tolerate a certain amount, but if I'm lending some enterprise, let's say dollars, and dollars are stable enough in this sense, I get back, let's say next year, the same number of dollars plus 5%, it's 5% interest rate. So that's great, but let's say now in Bitcoin, if I lend that enterprise 1 million Bitcoins in 2009, well, the problem is the enterprise is insolvent. There is no way it can repay 1 million Bitcoins today, because 1 million Bitcoins today would be $1 billion. So presumably there are very few enterprises that started 10 years ago that are worth $1 million that have such a high net worth that can actually repay a loan of $8 billion and still be solvent after repaying it. So the idea that the medium is going up, well, that's great for lenders, terrible for debtors. In fact, it's so terrible for debtors that it's actually bad for lenders. The lender has to care about the debtor, right? If I lend to somebody and he goes bankrupt, that's actually not good for me as the lender, even though the medium that he had lent me has gone up so much, and that's why he's bankrupt. I'm going to end up taking over his desks and computers and laser printers and real estate because he's not going to be able to pay. It's not really what I wanted. I didn't want to operate his business. I just wanted to get interest on my money. Now, from 2017, certainly through 2018, the price of Bitcoin dropped. It dropped pretty hard. It dropped from 20,000 to 3,000. And that's the flip side of it. Who in their right mind, headed into retirement at age 65, would put all of their wealth into a currency that had that kind of volatility? So from 2,000 down to 3,000, a $17,000 loss, what is that, 85%, am I right? 85% loss. Who could afford an 85% loss on their life savings at age 65? So it kind of precludes, the volatility itself precludes anybody being a lender in it. And at the same time, the flip side of the volatility precludes anybody from being a borrower. And if you can't have borrowing and lending in it, then it's going to fail the second definition of money, the extinguisher of debt. And the dollar fails in this as well. So what does this mean? So we make a loan because there's a productive purpose in doing so. We expect to get paid back. The problem with the dollar is, of course, the dollar is an IOU. So if you pay a debt paying with an IOU, you shift the debt, but you don't actually extinguish it. If you take a look, at least in, I don't know what the Australian currency notes say on them. The American currency notes say Federal Reserve Note. So bill, dollar bill, we all call it a bill. Bill is an archaic word for credit. Note is another word for credit. So it's a credit note of some sort. And we're paying using a credit note. So the debt cannot actually go out of existence. All you do is you take yourself out of the debt loop and you shift it. So if I count out dollar bills and I hand this over to my creditor, okay, I'm free to walk. I'm not going to be sued or arrested or whatever. But now the Federal Reserve owes this person the sum. This person is going to deposit this in a bank probably. And now the bank owes him and the Federal Reserve owes the bank. Then what's the bank going to do? Well, the bank is going to buy a treasury bond because, first of all, regulation, and secondly, that's their business model anyway. And now the treasury owes the bank who owes the depositor, and the treasury bond is payable in dollars. So there's a circularity there at the core of the whole system. The Federal Reserve note is the liability issued by the Fed to fund its portfolio, its assets, which is the bond. So the dollar bill is backed by the bond, and the bond is payable in the dollar bill, which is backed by the bond, which is payable in the dollar bill. So it's just a pure little circular, you could call it check-kiting scheme if you want. So the dollar does not extinguish a debt. Bitcoin could extinguish a debt if anybody would dare to incur a debt in Bitcoin, and anybody would dare lend in Bitcoin. And so there are some little lending markets in Bitcoin. I'm aware of it, but I think it's really only lending for two purposes, which is short selling or speculation, and people who want to expand their Bitcoin mining hardware can borrow in Bitcoin. In fact, they should borrow in Bitcoin. They shouldn't borrow in dollars. And so from an extinguisher of debt standpoint, I think both Bitcoin and the dollar are not really working right. Now, of course, today, I call this the Warren Buffett objection, that gold doesn't have a yield, and gold isn't used in borrowing and lending. And historically, it was. In fact, when you said bond before 1933, at least in America, it meant gold bond. They were all, I don't think there was any such thing as any other kind of bond in 1932. Maybe in 1870 there were silver bonds, but by 1932 it was gold. So it abruptly stops in 1933 because President Roosevelt decreed it. He just said, that's it. The dollar is no longer redeemable, number one. And by the way, number two, if we catch you with any of that gold stuff, it's a felony. Just like being caught with some white mind-altering powder today, it's go to prison. So, of course, some people turned in their gold. I think most people didn't. I don't think they got all that much of it. And so what they do, they drive it underground. People hide it. They bury it under the floorboards. In fact, there was a term from that time called midnight gardening. I just love that term. Midnight gardening. So people go out into the backyard and they dig a little hole and, oh, look, a new flower appeared at 2 a.m. How did that happen? And then underneath it, 4 feet down was a little gold wrapped up in whatever sort of bag that they had at the time. Gold doesn't tarnish, so it's perfectly safe in the ground. So they drive it underground. People don't talk about it. They tell their eldest child on their deathbed, oh, by the way, Daddy has some gold buried back there. You should go dig it up. So they make it illiquid. They make it impossible for Americans to trade in it. They don't actually kill its value, and of course they kill lending and borrowing, which now become exclusively irredeemable, or the dollar was made irredeemable for American citizens in 1933. So it worked for lending up until 1933, It didn't stop working in 1933, it was just simply made illegal to do so in 1933. And then the world obviously went through a war and went through some crazy, crazy monetary regime. I'm sure most of you know about the Bretton Woods Treaty signed in 1944. It may not be as well known. So everybody thinks this is great for America. The rest of the world call this America's exorbitant privilege. The architect of this particular privilege, so-called, was one Harry Dexter White, who was a apparatchik in the Roosevelt administration, and oh, by the way, later criminally convicted of being a tool for the Soviet Union. His goal was actually to undermine and destroy America, and this was his parting shot. And he came up with a quite effective means of doing exactly that. The rest of the world resents America for this, as it should, but at the same time, what appears to be a great privilege isn't actually working out for the Americans either, but it's working out, it's hurting them in a different way, and it's not necessarily obvious, but it's certainly undermining employment and industry in America. Without dwelling too much on that, I was making a point about, so why isn't gold used in borrowing and lending? Well, they made it illegal in 1933. It was re-legalized in 75. So in 1971, Nixon, have you all seen the video of this? It's on YouTube. If you haven't seen it, you should see the video of this where Nixon says, we're temporarily suspending the redeemability, blah, 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 and everything he says is just mendacious. And then it took a few years for officials to figure out that gold is done. They don't care anymore. It's nothing to do with the monetary system anymore. It's not a monetary asset. It's a dead, dry commodity. 1975, by that point, there was one James Blanchard, who was a paraplegic in a wheelchair, and he was an activist for legalizing possession of gold. And so I think it was at a Nixon campaign rally or something like that, that Blanchard hired the Goodyear blimp or one of the planes trailing a message or Skywriter or something. I don't know exactly, I have to dig up the story, but to basically say legalize gold now. And he called a press conference, and he's there like on the steps of one of the big important buildings in Washington, DC, and he's holding a 100-ounce bar of gold, and he's sitting in a wheelchair, and he says, I'm a cripple. I have this gold, which is a felony to possess. I dare you to arrest me. Well, Congress got the message, and of course, by that point, the monetary authorities had figured out, we don't care about gold anymore. Who cares? Fine, let them legalize it. Let's create a futures market in it. Let's turn it into a freaking casino. Everybody can roll the dice and bet on it. It goes up and it goes down, and obviously, in those days, it went up a lot more than it went down. It went from $35 an ounce when they set it free to, $850 by the end of the 1970s. And then there was a long sideways period and going up again. Point being, gold was used as a mechanism of lending, and it's my vision and my company's vision that it could be used again as a mechanism of lending. And in fact, I'm giving a talk this afternoon on how you can earn interest on your gold because we pay interest on gold and silver. So I think, and I've got a couple of minutes I'll leave for Q&A, I think I've covered sort of the key points of money, which is it has some functions it's supposed to perform, and different things that are competing for the title of money today perform those functions better or worse. I give it these two definitions. The first one's from Karl Menger, the founder of the Austrian school. The second one would be a lot more controversial, I think. Oh, currency. So what does currency do today as a medium of exchange really, really well? Well, it's basically frictionless. And so while currency is not a commodity, it's a credit, the currency is the most marketable credit. So there's all kinds of things. We have 30-year treasury bonds, we have agency paper, we have AA corporate credit, we have junk bonds, we have all these different things. We have commercial paper. You could stack rank all those things in terms of marketability. What you would find is the dollar bill is the most marketable of all of them. And that's what makes it a currency, not money, but currency. So I think I've got about 5.5 minutes for Q&A. Come on, I said a lot of controversy. Yes, sir.
Oh, sorry, I got the microphone. Thanks for your presentation. Look, my question is, do you think that the United States or other countries around the world would eventually go back to having a gold-backed standard to support their respective currencies? You mentioned that, like, the US did many decades ago, and England did. Other people out there in the gold industry claim that it might happen. What's your thoughts?
You know, I have the optimistic one and the pessimistic one. So the optimistic one is, I'm going to paraphrase a quote from Winston Churchill, and he was kind of laughing at us Americans a little bit, and he said, well, the Americans first, they try everything wrong, and then when they're done trying all those things, eventually they do the right thing. So when everything else fails, well, they turn to gold again, just sort of as a Hail Mary pass, maybe. That's my optimistic side. My pessimistic side is that the system today is itself irredeemable. What I mean by that is that every dollar that exists today was borrowed into existence with the expectation that it is irredeemable. And there's no way to retroactively declare that all of those irredeemable dollars are now gold-backed. The gold backing simply isn't there. And I don't mean it as a quantity thing. I mean it in terms of every borrower. Let's say you borrow $1 million, that's not enough in Sydney. You borrow $3 million in Sydney to buy a home. You don't have the gold income to amortize so what is the gold price here? It's 2,000? 2,500 an ounce. Let's call it 3,000 to make the math easy. So that would be, 1,000 ounces of gold. So how much income would you have to amortize, how much gold income would you have to amortize 1,000 ounces of gold debt? You haven't got it in 99% of cases. So there isn't a way to retroactively declare the dollar to be gold-backed or gold-redeemable. There is a way to build a market to transition from irredeemable dollars to gold-redeemable debt. And I wrote a paper called Using Gold Bonds to Avert Financial Armageddon, and that's what my company is trying to do, is to recreate gold credit instruments, including bonds. So we've been in conversation with a number of governments. We're issuing commercial gold bonds first, then we're going to bring out government gold bonds and hopefully create this market mechanism. Come to my talk this afternoon, I can talk about this more. Any other questions?
Got a question over here.
Howdy, Keith. Thanks for the presentation. Just a question about backwardation in the gold futures market and what that means for the dollar.
So question is, what about backwardation? So backwardation is when the price of a commodity is lower for future delivery than it is for spot delivery right now. This is something that should not happen in gold, but there's a lot of things in our monetary world today that shouldn't happen that do, like negative interest rates. I should say at the moment there is not any gold backwardation, but my thesis is that when gold backwardation really rises and becomes permanent, that is the harbinger of the collapse of the dollar system. So we publish, if you go to our website, it's free, we show the gold basis that would show backwardation. We have a daily updating graph on our website that shows that. Any other questions? Yes, sir.
Thanks so much for the talk so far, and I'm looking forward to this afternoon's as well. I wanted to ask, do you see a future where maybe we will price housing in gold, so like a 12.5 kilo worth house?
I do, yes.
18 kilos?
I do, yes. So an example might be Venezuela. Now, they're not pricing things in gold at the moment, but they've long since ceased pricing anything in bolivars.
Right.
The bolivar has become so useless. We have another expression in America, which is to stick a fork in it. They've stuck a fork in the bolivar, and so they're using something else, probably US dollars. Yes, I think we'll get to the point when people are using gold because the only thing that'll have the stability be meaningful.
Maybe Bitcoin will be like worth an ounce of gold, worth a kilo, and it will just be pegged to that? Reference to gold in the future?
I don't see any reason why Bitcoin shouldn't be priced in gold. Absolutely.
Awesome, wonderful. Thanks so much
All
for
right.
the talk.
Thank you.